Let's go across. We have Mr. P.R. Seshadri, who's the MD and CEO at South Indian Bank, joining us to give us a perspective on how he's on what the road forward is. And viewers, of course, you look back, but more importantly, in banks, what you ought to do is you got to look forward and see that is there a change or is there a turnaround coming around? And that 66% return surely attracts a lot of eyeballs. But Mr. Seshadri, it's first off a pleasure speaking with you. Let me first start off by understanding, does loan growth come back for you in a stronger fashion? Because this 12% 3-year CAGR growth doesn't really appeal much. I'm trying to understand on the small book size you have, is there an aspiration to grow much, much faster?
Thank you very much for having me on the show.
Great having you, sir.
Our growth rate has been sequentially increasing. So this quarter, we've grown 5% sequentially, quarter on quarter. We expect Q4 to be strong as well. Our indication to the market has been that this year we'll grow at 12%. And the reason why we are sticking to that is that we are actually trying to change the asset mix. We have a large corporate book, and our aim is to grow the personal, agri, and the business loan segment, and and see how we can moderate the corporate book that we have. And within the corporate book, we also have very high quality corporates that predominate, and consequently, that has the effect of moderating the NIMs that we earn. So as a strategy, our aim is to ensure that our cost of capital is kept very low. So if you were to look at the cost of deposits that we have, it is lower than our peers. We don't want to have that increase. And there is a natural rate at which deposits accrete for us, which is roughly about 12%. And if you were to try and accrete deposits faster, we'll end up having to pay rates at the margin closer to what our competitors are offering. And that would take our cost of deposits up. So what we are now trying to do is to ensure that our profitability improves by changing our asset mix while we keep our cost of deposits where they are. And I think we've had reasonable success over the last 7-8 quarters to ensure that the numbers reflect what we are trying to do.
Mr. Seshadri, I want to delve a little bit into what you've just said. You've said you want to move away from corporate, or rather you want to reduce the weightage of corporate in your loan book. How much will that go down by? And also the other piece, currently the Indian corporate is at a very interesting juncture where corporate balance sheets are extremely clean. Is this the best time to follow this strategy? Give us the rationale for that.
I think you make a very good point. Corporate balance sheets are in really good health, but it is a trade-off that you make. So if you look at our investor deck, you'll see that approximately 98% of our large corporate loans, which is loans over 100 crores, are to entities that are rated A and above. And about 93-94% is to entities rated AA and above. And the issue with that is that the spreads on facilities made available to them are very, very narrow. And given the fact that we do have to eke out reasonable profits, we are trying to find appropriate niches within which we can make credit available and improve our NIMs. So as you rightly mentioned, our NIMs increased from 2.8 to 2.86% sequentially from Q2 to Q3. And given that there was a repo cut of 25 basis points in December, we do have to do a reasonable amount of work to ensure that NIMs continue to grow in the future. We do give effect to RBI's repo cut on a T+1 basis, which means that if repo were to be cut today, the customer would enjoy the benefits starting from tomorrow. And under those circumstances, it's important for us to manage the asset mix as dynamically as possible to ensure that the P&L continues to be robust.
Great points, all valid, Mr. Seshadri. So thank you for that. Let me extend this question a little further. So where does your corporate book go? Where are you most comfortable with the corporate book sitting as a part of your overall loan mix? That's my first part. The second part is trying to understand what the yields are with regard to corporate versus retail. What would the yield differential be, if you can give us a sense?
So our corporate book right now is about 40%. That includes the transactional banking business, which is part of corporate. We would like to see that move to about a third of our total balance sheet in the near to medium term, and in the long term, drop that a little bit further. But we are looking at the near to modern medium term only right now, and we're not, so focused upon the long term numbers. Um, the spread differences is something that I'll have to hazard a guess. I don't have an exact number with me, but I would think it would be in the neighborhood of about 200 basis points or 250 basis points would be the spread differential between the two, corporate versus the others on an averaged basis.
That should, apologies for interrupting, that should improve your margins substantially, right? You're currently at 2.86. At 100 to 200 bips improvement there could be big for your margin number.
Yes, and that's the challenge that we have, and that's what we are trying to do, and that's the reason why we believe that we don't really need to grow our total asset book as aggressively as some others would need to have flow throughs into the P&L line. And you had made an earlier point with respect to our expenses. So if you were to look at our expenses over the last 8 quarters, you will see that expenses have been managed very, very tightly. So this quarter also, we had positive operating leverage. Revenues grew faster than expenses. Revenues grew at 7%, expenses grew at 4%. And if you were to, for the 9-month period also, we have positive operating leverage, as we did during the last year as well. So if we were to improve our margins, our focus on costs should ensure that that flows through into the pre-provisioning operating profit line and thereafter into the profit line.
Great points. Okay, now let me try and unpack that a little bit. So you've said 10% of your book will shift from corporate to retail. That should have an incremental 20 basis points addition to your margins, if I've understood it right. Because 200 basis points, but 10% of your book. I'm just doing rough math here. So roughly 20% added to your margins, very likely. Is my understanding right, sir? And second piece, I'm trying to understand now that your margins start going upwards, do they go back to the traditional 3.3% or will it be lower? Where does your steady state margin lie, on top of which you will accrue another 20 bips because of the shift in loan mix?
So broadly what you're saying is right. If the transition from the current product mix to the one that we want takes place, the 20 basis point incremental margin mathematically should accrue. We are also inter se within the retail and MSME and other businesses. We are trying to optimize in such a manner that the risk reward trade-off works for us. So as of this moment, we are working to get our margins back up towards the 300 basis point number. We are hopeful that there are no further repo cuts, and that's our first goal. And once we achieve that first goal, we will think about others subsequently. And that's the approach that we've been following. And I think our trend lines, if you see the numbers that we've been publishing, our trend lines are reasonably robust. And I think we do have a reasonable chance of getting there if the repo rates do not materially change in the marketplace.
Talk to us also about the OPEX piece that you spoke about. How much calibration do you have with, or what kind of levers do you have to kind of allow that operational efficiency to play out, and how much of that will spill over to operating profit and ROA, just the OPEX part?
On the OpEx side, we've controlled it really, really tightly. Majority of our cost is actually manpower costs, and there we've kept a very tight lid on total staffing levels within the company. And we focused on getting greater efficiencies. So if you see our investor deck, we have a slide that talks about productivity at the branches. So as of this moment, we think that our branch productivity over the last 6 quarters have increased by roughly 86% or thereabouts. And that is what is driving both revenue growth as well as the profitability growth that you see. So costs have been managed very tightly. Total number of headcount within the company is actually lower than where it was 6 quarters ago. And employee costs very tightly controlled, total costs very tightly controlled, whereas throughput has been increased, both by virtue of new systems and new processes, and also new products that enable us to work more efficiently. And that's why you're seeing significant increases in profitability.
Mr. Seshadri, give us some color around what your fixed versus floating book is.
So roughly about 40% of our book is indexed to external benchmarks, which is repo and treasury bills. And the rest is either an MCLR or fixed rate and so on and so forth, less variable. So you could say 40% roughly is the external benchmarking book.
Okay. What's the credit cost aspiration? Because you're at sub 8% on yield. So my guess is you're doing extremely safe loans, right?
Yes. We are trading off quality for revenue. We are trying to make appropriate adjustments so that we do get in some amount of medium yielding assets as well, rather than just the low yielding assets, which is the shift to retail that we were talking about. With respect to credit costs, actually our slippage rates are I think amongst the better slippage rates in the market. For the quarter, our slippage was 16 basis points, which if you annualize is 64 basis points. In the prior quarter, it was 21 basis points, and the quarter prior to that, it was 20 basis points. So our portfolio is in great shape, and very little of it is actually getting into the NPA stage. You are seeing credit costs that are slightly higher than what is warranted by the slippages, essentially because of the fact that, as a company, we did have high NPAs in the past, and provisioning requirements have caught up. And as a consequence, we are making incremental provisions so that the net NPA numbers reflect the high quality of the book that we currently have.
Right. Mr. Seshadri, you're expecting near-term margins to hit 3% if there are no more repo rate cuts. That should flow through straight to ROA. How much of a scope does ROA have to expand? Will it be a 15 to 20 basis point expansion you could see in 2 to 3 quarters, if at all there is no repo rate cut?
So I'm not saying there will be a 20 basis points increase in margins immediately. I mean, there is the transition from 40% corporate down to 30% corporate by your own computation. And that will take a little bit of time, in spite of the fact that our balance sheet is, as you rightly mentioned, sub 100,000 crores. So as and when that happens, we do expect this margin increment to happen. We do have the levers. The point that I'm trying to make is we have multiple levers to manage profitability. And we do think that we have a pathway to higher return on average assets over a period of time. There are multiple levers that are available, which we will use as appropriate as we go forward.
Excellent. Thank you so much, Mr. Seshadri, for coming in and speaking with us. You've been candid. And you've obviously given us a lot of food for thought. So thank you so much for joining us.
Thank you very much.